Infrastructure as an asset class is quite different to many other asset classes because there is actually no agreed definition of what infrastructure is. If you look at the various benchmark indices that are used to look at the infrastructure, what you find is that constituent stocks are all quite different in those indices. And that then means that the individual managers have got to define what their potential investment universe is. And so for us, when we're looking at the potential stocks that we're looking for, these are the sorts of things that we're looking for. Firstly, the asset needs to be essential for the efficient functioning of a community. Just about every other manager would say that. But the next point is where we actually differentiate ourselves. We don't want to invest in assets that are sensitive to oil prices, commodity prices generally, competition or sovereign risk. So this means there are lots and lots of stocks in the benchmark indices that fail our definition. We didn't set out specifically to be this way, but it turns out we have the most conservative definition of the term infrastructure in the market, not just in Australia, but globally. What we're trying to do is get together a bunch of stocks that are very defensive, inflation linked. And as you'll see in a moment, that's been a very significant factor in the way that we've outperformed the market in recent times. And I'll give you a very quick example of what I mean by we don't want exposure to commodity prices or competition. If you look at the power industry in most countries of the world, including Australia, it's set up like it is in this diagram here, where the power stations operate in an unregulated competitive environment. They produce a commodity that they can't store. They have to take whatever price is on offer. That price is impacted by weather, it's impacted by economic conditions, and most importantly, it's impacted by how many other people are producing electrons at the time. In many countries of the world, they also have to buy the energy source, the coal or the oil. So they've got commodity price risk at both ends of the spectrum. So for us, a power station is not infrastructure unless it is regulated. And there's still some parts of America, for instance, where it is. The poles and wires that carry the electrons are monopolies. There's only one set of poles and wires going past your house. It's regulated, and that's clearly the sort of asset, boringly defensive but very predictable asset that we're trying to find to put into this fund. So that's all pretty straightforward. But what happens if the company does all of it, it's vertically integrated? Is AGL infrastructure or is it not, for instance? And for us, the answer is it's not unless 75% of the earnings consistently come from that regulated part of the business. So AGL fails our definition. Just to give you an indication of how, in a practical sense, that's important, what I'm showing you here are the returns in local currency of the constituent stocks of the S&P Global Listed Infrastructure Index. So this is the benchmark index we use. So this is the returns for the last financial year. The ones in blue are the ones that are a part of our investment universe, not necessarily in our fund, but they're the stocks that we are looking at and valuing and deciding whether to put into the fund or not. And you can see what happened last year is that our universe of stocks all performed quite solidly. Most importantly, though, we avoided all the stocks that got hammered last year. And what were they? They were oil and gas pipelines that had commodity price risk. They were stocks in emerging markets where we won't invest, so we won't invest in China, for instance. And there was quite a number of the very large European power generation companies that also got smashed. So we avoided all of them. Everything we do at Magellan is about not losing money in the first place, and that was a very good example of how that happened. There's some performance statistics there. The only one I really want to concentrate on, given the limited time, is the second line, downside capture. So the funds, so we're talking about the fund now, our downside capture on the MSCI was negative for the last 5 years. In other words, on average, when global equity markets went down, our fund delivered a positive return. And the downside capture on the ASX was also negative. Now, I'm not saying it's going to happen going forward, but it's a very good indication of how defensive this is. And if I give you a very quick example, in the month of June, when Brexit happened and stock markets throughout Europe and in particular in the UK collapsed, our best performing stocks were UK stocks. On average, our UK stocks in the fund went up 10% in the month of June, almost all of it in the last 3 trading days, as people were trying to find somewhere defensive to hide in the middle of all that carnage. we're index agnostic the way we run the fund. At any one time, we've got about 30 stocks in there. We can hold up to 20% cash. We're about 10% at the moment. That's not a defensive position, that's dry powder. We're expecting lots of volatility in the market going forward in the next 12 months, so we want that cash to be able to take advantage of it. We're essentially a buy and hold investor. Our turnover on this fund is only about 15%, which is extremely low by comparison with our peers or other people who invest in listed markets. We can invest in emerging markets. There's really only one emerging market that we ever monitor with any seriousness, which is Brazil. We haven't invested in any of the non-OECD countries in the last 5 years, and I don't expect we will in the very short term. I'm going to flip through that slide. Very quickly, where are we invested? On the left-hand side is the sectors, on the right-hand side, geographies. The yellowy orange colours are your regulated utilities on the left-hand side, and the bluey colours more your infrastructure stocks. So you can see reasonably well diversified across the various sectors. In terms of the countries that we're investing in, about 25% of the fund currently in the US. If you went back 3 or 4 years ago, you would have said that was closer to 40%. US stocks have become fairly expensive, and we've been selling down there and moving into some better opportunities in Europe. There's the top 10 holdings. Because we're short on time, I won't go through them in any detail. You can see Transurban is our biggest holding and has been for quite some time. Just very quickly, Crown Castle is a company in the US that owns towers that the mobile phone companies rent space on to put their transponders. National Grid owns the high voltage transmission network in the UK, as well as the main gas distribution network, as well as some very large power utility assets in the UK. And the last one I'll comment on is Atlantia. Atlantia is an Italian company, owns about 3/4 of the motorway network of Italy, plus Rome Airport, plus some very high quality toll roads in Chile and Brazil. So in conclusion, the strategy we've got in place here is not a particularly sophisticated one. The only derivatives we use are for hedging the fund. It's a fairly simple strategy that relies on very deep research. We've got 9 people in the team covering about 90 stocks. It's a very simple approach, but it's very disciplined and it delivers very predictable outcomes. And as Jennifer said, in the longer term, we expect this strategy to deliver inflation plus 5 to 6% at the least, and we would expect to do that virtually regardless of what's happening in the economic cycles. So in other words, if the markets are strong and going up, we will underperform almost certainly, and we have no intention of changing the style or the approach we take in that situation. This is an insurance type of product where we will perform strongly regardless of what's happening. So when you get those unexpected shocks like Brexit, this is the place that's going to give you that defensive quality.